building the cost sheet. It's really important to identify all possible costs that can impact your business. There are two types of costs: operating costs and capital costs. They are kind of like what they sound: the costs you have to operate your business, and the capital costs, which means the stuff you buy, like equipment or laptops or machinery or furniture, etc. While building your cost sheet, you start with only the operating costs. Once again, your columns are the months, and the first column is a list of all of the operating expenses. Here's a suggested list of operating costs. Manpower costs from the manpower sheet, rent or office costs, what's often called T&E or travel and entertainment and meals, etc., internet and cloud hosting, marketing, telephony or communications, legal or finance. Now let me introduce you to a concept of interdependency. The revenue figures that you have must have a corresponding cost associated with them, generally broken down in what we call fixed and variable costs. For example, office overhead's a pretty fixed cost, but the cost of selling, providing or making a product is variable. The more you sell, the more that cost changes, where the fixed costs, like office, could stay pretty much the same no matter what you do about your volume of sales. You can't exponentially increase revenue without increasing your direct variable costs, and those figures must tally with your unit economics. Total all the costs month-wise. Revenue less the costs would give you a figure called EBITDA, earnings before interest, tax, depreciation, and amortization, EBITDA, EBITDA. Let's go back to one thing. As I mentioned before, in addition to your fixed and variable costs, you often have costs called capital costs, the cost for buying things. This is the cost for buying computers or furniture or manufacturing machines, etc. In generally accepted accounting, you don't actually expense a capital purchase, like for a manufacturing machine, in the month you buy it. You depreciate it over time. So your forecast won't show lumps of money that you put out to buy things like a server, but you will still need to reflect a budget for it, as you'll need to spend that money. If you can't get something like a lease, then in fact you're really going to spend that in a lump sum, but in your forecast for the budget, accounting-wise, you'll depreciate it. I'll explain that in a minute. We won't go into the concept of depreciation here, but you do need to familiarize yourself with it or ask your advisors. The accounting rules for depreciation vary from country to country, so it's particularly important that you check this out. Let's assume that laptops can be depreciated over 3 years, and you're spending $24,000 in buying laptops at the beginning of your process. Your cash flow is $24,000 out, but you'll depreciate the $24,000 over 3 years at $8,000 a year, or $666 per month for capital equipment. As we reach the bottom of the financial forecast, now that you've calculated depreciation, you're ready to put in your net profit line. That will be your expenses plus taxes, interest, depreciation, and amortization. An interim number you and your investors will want to look at. That's that number we called EBITDA, earnings before interest, tax, depreciation, and amortization. This reflects the real cash you're likely to put out for your core business other than the capital purchases. You'll need to add one more set of numbers to your cash flow forecast, and that is the actual capital purchases. This includes the cash purchases of the goods I talked about, like furniture and computers and servers and so on. It'll also include things like rental deposits, which you might have to put forward. So now what you're understanding and showing investors are the actual net costs of your business in cash. This is how much money you'll need to bring in to run and operate a profitable business to success.